Hey there, and welcome to the Property Wealth Podcast. If you're in your 40s or beyond and looking to build long-term wealth through real estate, you're in the right place.
Absolutely, Sarah. Today we're diving into something super important, building credit for bigger loans. It's a crucial step for any aspiring real estate investor.
Right. Good credit can really open doors. Or, make it a lot easier to secure those bigger loans that can help you invest in properties.
Exactly. We'll talk about the fundamentals of credit scores, the factors that influence them, and some practical tips on how to improve your creditworthiness. It's all about setting yourself up for success.
And we'll also touch on common pitfalls to avoid, things that could really impact your ability to get those loans. It's all about making informed decisions.
Plus, we'll share some real-life examples of how improving your credit has helped others in their investment journeys.
Yeah, and by the end of this episode, you'll have actionable steps to take so you can feel more confident when it comes to securing that financing.
So let's jump right into it. What's the first thing listeners should know about their credit scores? Sarah, when we talk about building credit, it's not just about getting a loan. It's about securing your future, especially for folks over 40.
Absolutely, Mike. There's this growing concern around retirement timelines, right? Many people are starting to think about how they'll sustain their lifestyle once they stop working.
Exactly. And with inflation constantly on the rise, what we thought we could live on might not hold up as well as we expect.
Right. I was reading about how living costs have been increasing way faster than wages. It's a real concern.
It is. And for someone over 40, building a solid credit profile can really be a game changer. It opens doors to larger loans, which means more investing power.
Yeah, and it's not just about you anymore. It's also about the next generation. I've spoken to several investors who share that their motivation is to create a legacy for their kids, right?
Absolutely. I had a client, let's call her Linda, who started investing in real estate after her kids moved out. She wanted to build a nest egg, not just for herself, but for her children. Something they could rely on.
That's a perfect example. And it also ties into the emotional side of financial security. Knowing you're building wealth not just for you, but for your family, it can really bring peace of mind.
Definitely. Think about it. If you have rental properties generating income, that can help cover expenses in retirement and even give your kids a boost later on.
And with the current economic trends, it makes sense to have multiple streams of income. Real estate can be a hedge against inflation.
Right. If property values rise, your investment appreciates, but your mortgage payments, if you have a fixed rate, stay the same. That's a powerful tool for maintaining purchasing power.
I can see how that would be really appealing. It's like having a safety net that grows over time.
Exactly. And then there's the market shifts we've been seeing. For example, many people are realizing that traditional retirement savings accounts might not be enough to sustain them.
You're right, and I've heard that from a lot of folks in our community. They're looking for alternatives, and real estate is often at the top of that list.
It is. And think about emotional security, too. When you have tangible assets like properties, it can boost your confidence. You feel more in control of your financial future.
Totally. I've seen how that shift can change someone's perspective. Like, one of my friends was really stressed about her finances until she bought her first rental property. It was as if a weight had been lifted.
That's such a common story. It's not just about the money. It's about feeling empowered, knowing you have something valuable that can provide for you.
And then there's the idea of wealth transfer. When you invest wisely now, you're not just thinking of your retirement, but also how you can help your family in the future.
Right. I've got clients who specifically want to ensure that their properties can be passed down to their kids. It's like planting a seed for future generations.
That's beautiful. And it also encourages those kids to think about investing early on, right? It's a cycle of wealth building.
Exactly. And that's why building your credit matters now more than ever. It's about taking action today for a more secure tomorrow.
And, with the current market shifts, it's more important than ever to be prepared. Those who are proactive about their credit are going to have the upper hand when opportunities arise.
Yeah, there are always opportunities, but not everyone will be ready to seize them. Having a strong credit score gives you leverage in negotiations and access to better financing options.
Right, and it can mean the difference between getting that dream property or missing out.
Exactly! And I've seen it firsthand. A client of mine, let's call him Tom, worked diligently on his credit over a couple of years. He was able to secure a much better interest rate for a property that ended up being a fantastic investment for him.
That's inspiring. So it really pays off to be proactive about credit.
Definitely. And let's not forget about the current economic trends. With interest rates fluctuating, having good credit can help you lock in favorable terms before they change again.
Right. And we all know how quickly things can shift in real estate.
Exactly. You want to be in a position where you can act quickly when the right opportunity comes along.
And that kind of readiness can be a huge relief, especially when you're thinking about your future and the kind of legacy you want to leave behind.
Absolutely. It's about more than just numbers. It's about your peace of mind and the security you're building for yourself and your family.
So with all of that in mind, it sounds like it's time to dive into some strategies for building that credit.
Yes, let's do it. There are some practical steps we can explore that will help listeners improve their credit scores and position themselves for those bigger loans. So let's dive into some core strategies for building your credit, which is essential for securing those bigger loans.
Right, because the better your credit, the better the terms you can get on a mortgage, right?
Exactly. One of the simplest rules of thumb is to keep your credit utilization below 30%. That means if you have a credit card limit of, say, $10,000, you want to keep your balance under $3,000.
That makes sense. So if someone is near their limit, it might be a good idea to pay it down before applying for a loan?
Absolutely. And paying your bills on time is crucial. Late payments can really ding your credit score. A good habit is to set up automatic payments for minimums, or even better, try to pay off the full balance each month if you can.
Right, staying on top of those payments is key. What about inquiries? I've heard that too many can hurt your score.
Yes, that's true. When you apply for credit, it can trigger a hard inquiry, which may lower your score slightly. It's smart to limit your applications, especially in the months leading up to a big purchase, like a home.
Got it. So if someone is thinking about buying a property, they should probably check their credit report first, right?
Definitely. You can get a free report once a year from each of the major credit bureaus. It's a good way to spot any errors or things that could be fixed.
And fixing those errors could potentially boost your score, right?
Exactly. It's worth the time. Now, once you have a solid credit score, you can start looking into different financing options. Traditional loans, FHA loans, or even private lenders.
What's the difference between them?
Well, traditional loans usually require a higher credit score and down payment, generally around 20%. FHA loans, on the other hand, are designed for first-time home buyers and allow for lower credit scores and down payments as low as 3.5%.
That sounds like a good option for people just starting out. But what about private lenders?
Private lenders can be more flexible with their requirements, but that often comes with higher interest rates. They might be a good option if you're looking at a fix and flip project, where you need quick access to cash.
So it's about finding the right fit for your situation, huh?
Exactly. And speaking of fit, let's touch on property types. Different properties can have different financing options and return expectations.
Yeah, I've heard that single-family homes tend to be easier to finance than multifamily units. Is that true?
Generally, yes. Lenders see single-family homes as less risky, but multifamily properties can provide better cash flow. The key is knowing what you want out of your investment.
Right, and then there are rules of thumb like the 1% rule, right?
Yes! The 1% rule is a quick way to evaluate rental properties. It suggests that the monthly rent should be at least 1% of the purchase price. So if you buy a property for $200,000, you should aim to rent it for around $2,000 a month.
That's a helpful guideline. But is it always realistic?
Not always. In some markets, you might find that properties rent for less than that, so it's important to do your homework on local rental rates.
Makes sense. What about the 50% rule?
The 50% rule is another handy guideline for estimating operating expenses. It suggests you should expect to spend about 50% of your rental income on expenses like maintenance, property management, and vacancies. So if you're bringing in $2,000 a month, plan on $1,000 for expenses.
That's a great way to keep your expectations grounded. What else should investors look at when evaluating a deal?
A deal evaluation checklist can be invaluable. You should consider the location, the property condition, potential for appreciation, and the cash flow it'll generate.
Right, and having a specific checklist can help you stay organized and focused, especially when you're looking at multiple properties.
Absolutely. And don't forget about the cap rate. It's a metric that helps you determine the potential return on an investment property. It's calculated by dividing the net operating income by the property's purchase price.
So, if a property generates $20,000 a year in net income and costs $200,000, the cap rate would be 10%?
Exactly. A higher cap rate generally indicates a better return on investment. But again, context matters. A 10% cap rate in one market might be normal, while in another, it could be exceptional.
Got it. So it's not just about the numbers, but also about understanding the market dynamics.
Right. And speaking of dynamics, it's crucial to stay aware of common pitfalls that can derail your plans.
Like what?
One big mistake is underestimating costs. Many new investors focus solely on the purchase price and forget about renovation costs, closing costs, and ongoing expenses.
Yeah, and that can really eat into your cash flow, right?
Exactly. Another common pitfall is failing to account for market trends. If you invest in an area that's declining, you could face significant challenges down the line.
That's a tough lesson to learn. So being informed really is key.
It sure is. Keeping a pulse on the market, understanding your financing options, and having a solid strategy can make all the difference in building your property wealth long term. So, let's dive into some of those common pitfalls, right? I think one of the biggest mistakes I see is over-leveraging.
Yeah, that's a big one. It's tempting, especially when you hear about people making huge profits quickly. But it can really backfire, can't it?
Absolutely. I remember a client of mine, let's call him John. He was so eager to get into the market that he took out loans on multiple properties, thinking he could manage them all. But when the market shifted a bit, he found himself stretched too thin and ended up selling at a loss.
Ouch. That's tough. So what should someone like John have done differently?
Well, the key is to really assess your financial situation before making those big commitments. Start with a solid budget and maybe only leverage a small percentage of your total assets. It's about finding that balance. You want to grow, but you don't want to risk it all.
Right, and speaking of risks, what about bad tenants? That's another common pitfall, isn't it?
For sure. I had another client, let's call her Lisa. She was so excited to rent out her first property that she didn't do a thorough background check on her tenant. Turned out, the tenant was behind on rent within a couple of months. And then, there were complaints about damage to the property.
That must have been a huge headache for her.
It really was. Not only did she lose money on the rent, but she also had to spend extra on repairs. I always tell my clients to take the time to screen tenants thoroughly, check references, credit history, past rental history. It's worth the effort up front.
Yeah, it might feel like a hassle, but it can save you so much trouble down the line.
Exactly. And then there's the issue of cash flow. I often see investors who get so caught up in the excitement of a property that they overlook the cash flow aspect.
Right. They might think, it's a great deal. But if the numbers don't work, it can lead to trouble.
Yes! I had a friend who bought a property in a great neighborhood, but the rental income wasn't enough to cover the mortgage payments and maintenance costs. He ended up having to dip into his savings to keep it afloat.
That's a real struggle. So what do you suggest to avoid that situation?
It's all about doing your homework. Look at the potential rental income versus your expenses. Aim for a positive cash flow, ideally. I'd suggest using a cash flow calculator to understand your numbers better before making any decisions.
That makes total sense. And what about timing the market? I know a lot of investors get caught up in that.
Yeah, that's a tricky one. I had someone reach out to me who was convinced that prices would drop significantly, so he held off buying for months, waiting for the perfect moment. But guess what? Prices went up instead.
Oh no! That must be so frustrating.
It really is. The market can be unpredictable, and trying to time it perfectly is often a recipe for missing out. It's better to focus on long-term strategies instead of trying to chase trends.
Absolutely. And then there are those hidden costs, right? People often underestimate what they'll actually need to spend.
Yes, I've seen that so many times. One investor I know bought a property thinking it was in great shape, but he didn't account for things like closing costs, maintenance, and property management fees. He ended up with unexpected expenses that really cut into his profits.
That's such a good point. It's crucial to factor in all those extra costs when budgeting for a property.
For sure. I always tell my clients to set aside a reserve fund for those unexpected expenses. It's like a safety net. You never know when you might need it.
Right, it's better to be prepared than to be caught off guard. So how can someone spot these red flags early on?
Well, I'd say start by doing thorough due diligence. Research the property, the neighborhood, and potential tenants. Look for signs of neglect, like a poorly maintained property or questionable rental history. And trust your instincts. If something feels off, it probably is.
That's so true. Listening to your gut can save you a lot of headaches.
Exactly. And don't hesitate to ask questions. If a seller or agent is evasive about certain details, that's a red flag right there.
Yeah, communication is key. So if someone finds themselves in one of these tough situations, what are their options?
Well, first, it's important to take a step back and assess the situation calmly. If it's about over-leveraging, consider talking to a financial advisor about restructuring your loans or refinancing.
That makes sense. And for issues with tenants?
If you have problematic tenants, document everything. And, if necessary, consult a lawyer about your options to evict or recover damages.
And cash flow issues?
Reevaluate your expenses and see if there are ways to increase your rental income. Maybe through renovations or adjusting rents if the market allows.
Great advice. It's all about being proactive, right?
Exactly. And remember, real estate is a long game. It's about learning from your mistakes and adjusting your strategy as you go along.
Well said, Mike. I think that's a great note to end on as we move into our next steps for the listeners.
Absolutely. Let's help them make informed decisions moving forward. All right. So let's dive into some immediate steps that folks can take right now to start building their credit and, prepare for those bigger loans.
Absolutely. It's all about actionable steps. So what's the first thing they can do?
Well, I'd say start by checking your credit report. It's free once a year from each of the 3 major credit bureaus, TransUnion, Experian, and Equifax. You can get a really good idea of where you stand.
Right. And that way, you can identify any issues that might be dragging your score down.
Exactly. And once you get your report, look for any inaccuracies or old debts that you might be able to dispute. You'd be surprised how often these reports have errors.
And fixing those can really give your score a boost. What about credit utilization?
Great point. Keeping your credit utilization below 30% is crucial. So if you have a credit card with a limit of, let's say, $10,000, try to keep your balance under $3,000.
Makes sense. And if someone finds they're over that limit, it might be worth paying down those balances as quickly as possible.
Definitely. And also consider asking for a credit limit increase. If your income has gone up, or you've been a good customer, they might be willing to bump that limit up, which can lower your utilization ratio.
That's a smart move. What about tools? Are there any apps or websites you'd recommend for tracking credit scores?
For sure. Apps like Credit Karma or Mint can help you keep an eye on your credit score and alert you to any changes. They're super user-friendly.
Yeah, I love Mint for budgeting too. It's great for tracking expenses along with your credit.
Another useful tool is a site like Zillow or Bigger Pockets. They not only provide valuable information about properties, but also have calculators that can help you analyze potential deals.
Oh, those calculators are amazing. You can really see how numbers work out before making a commitment.
Right, and speaking of analyzing deals, I suggest setting a goal to analyze at least 1 deal per week. Even if you're not ready to invest immediately, just getting familiar with the numbers is so beneficial.
That's a fantastic habit to build. What about local resources? Are there any meetups or groups you'd recommend?
Absolutely. Check out local real estate investment groups or meetups. Bigger Pockets has a great community, and many cities have local chapters. Connecting with others can provide insights and support.
Networking is huge. Plus, you can learn from others' experiences, which can save you time and money.
Exactly. And don't forget about books. There's a wealth of knowledge out there. The book on rental property investing by Brandon Turner is a solid read.
Oh, I love that one. It really breaks down the process step by step.
Another good one is Rich Dad, Poor Dad by Robert Kiyosaki. It's not just about real estate. It's about building a wealth mindset.
Such a classic. And podcasts? What about those?
There are plenty of great real estate podcasts out there. Bigger Pockets podcast is a must listen. They cover everything from financing to property management.
Yeah, and the stories they share are super motivating.
Exactly. Just listening to others' journeys can really inspire you to take action.
So with all these resources, people can definitely start taking steps today.
For sure. And remember, it's all about starting where you are. Even small steps can lead to big changes over time.
Right. And consistency is key.
Absolutely. So gather your resources, set those goals, and take action. You've got this.
With these tools in your pocket, you're ready to move forward. Let's recap what we've covered today.
So, as we wrap up our conversation today, let's summarize some of the key takeaways from our discussion on building credit for bigger loans.
Absolutely. One of the biggest points was the importance of checking your credit report regularly, right? It's like knowing where you stand before you make any moves.
Exactly. And correcting any errors on that report can really make a difference. You don't want something minor holding you back from a great investment opportunity.
And then there's the point about maintaining low credit utilization. Keeping your balances low relative to your credit limits can really help boost your score, right?
That's spot on, Sarah. Plus, we talked about the value of establishing a solid payment history, paying your bills on time. Just that consistency can greatly enhance your credit profile.
Right. It's all about being disciplined and aware of your financial habits. And, of course, diversifying your credit types by mixing in different kinds of credit can also help.
Yeah, and remember, building wealth through real estate isn't just a sprint. It's a marathon. It takes time, patience, and a solid strategy.
Absolutely. And every small step you take today can lead to big rewards in the future. So don't get discouraged. Stay focused, and you'll get there.
If you found value in today's episode, we'd love for you to like, subscribe, and share your biggest takeaway or any questions in the comments. And hey, if you know someone over 40 looking to invest in property, share this podcast with them.
Yes, please do. And next time, we'll dive into DSCR loans, those no income verification loans that can really open up some doors for investors.
That's a topic you won't want to miss.
Thanks for joining us today, everyone. Until next time, keep building that wealth.
Take care, everyone.